Time is running out to fix this IRA mistake and avoid a 50% penalty. Tax season is prime time for catching and fixing last year's individual retirement account slip-ups. Whether you put away too much money in your IRA or you forgot to take out a required minimum distribution (UIE), a mandatory withdrawal after you turn 70, your accountant is likely to discover your mistakes. Missed. More from Smart Tax Planning. Bail. While IRAs are a valuable source of retirement income, the IRS can slap savers with penalties if they mess up the rules of how they work. The good news is that you can get right with the taxman this spring. Here are a few of all IRA mistakes. Missing that RMD after you've turned 70 might be one of the most costly oversights. Savers have until the end of the year to make this withdrawal. If you have fail to take the RMD, and you could get a 50% tax penalty on the withdrawal you should have made. Here's the good news: the IRS might waive the penalty if you catch your mistake early and fix it. First, take the missed RMD as soon as possible. As you prepare your taxes, file, which spells out the so-called excess. Finally, attach a letter of explanation, telling the IRS that you made up the missed distribution and explaining why you failed to take the withdrawal last year, said Ed Slott, CPA and founder of Ed Slott & Co. Tax geeks might be familiar with the Qualified Charitable Distribution, a tax-efficient strategy that allows you to transfer money from an IRA to a qualifying charity in lieu of an RMD. Be aware that when it comes to Roth IRAs and traditional IRAs, there is such a thing as saving too much. For 2018, savers are able to contribution up to $5,500 in an IRA or Roth IRA in total. If you're over 50, excess contributions are subject to a penalty tax of 6% each year. It's pretty easy for savers to save too much money in these accounts. For instance, maybe you saved $5,500 in your IRA last year, forgot about it and made another contribution just prior to filing your taxes this spring. Indeed, January 1 through April 15 is a period when savers can put money in an IRA and have it count for either 2018 or 2019. Or maybe you've been contributing to a Roth IRA, but last year you had a raise. As a result, savers with MAGI over those thresholds in 2018 are unable to directly contribute the full $5,500 to their Roth IRAs. If they make the best course of action if you've put too much money in your IRA or Roth IRA is to take the excess contribution out immediately, said Stefan. If you withdraw the extra cash and the earnings prior to the due date of your tax return, you can avoid the 6% penalty. On the excess contribution will be subject to taxes, and you might pay a 10% early withdrawal penalty. The alternative is that you can leave the cash in and reduce your 2019 contribution by the amount of extra money you put into the account. For instance, let's say you were limited to a $5,500 contribution for 2018, but you had put in $6,500. You can carry forward. That means instead of contributing the 2019 max of $6,000, $7,000 if you're 50 and over to your IRA, you would reduce your contribution for this year by $1,000 to account for the excess you had paid earlier.
Raindrop, drop top, smoking, no cooking the hot pot. Fucking on your bitch, yeah, that. Looking up, open the park pot.